Welcome to Real Vision Crypto. I'm Ash Bennington. Today, I'm joined by Bill Barreit, CEO of Abra. We talk trading, borrowing, and lending of cryptocurrency. Bill, welcome to Real Vision Crypto.
Thanks, Ash. Great to be here.
It's a pleasure to have you. Bill, we were talking a little bit off camera. You've had a very interesting career before cryptocurrency. Tell us a little bit about your background.
Yeah, it's been a kind of a little bit of an eclectic, circuitous path to get to crypto. But I was a cryptographer developing secure messaging back in the late 80s at CIA. I worked in fluid dynamics simulations and research at NASA. Was a quant at Goldman on Wall Street. So yeah, and then found my way to the internet in the mid 90s, worked on some projects related to the original SSL, HTTPS that we all use to secure credit cards, and then a lot of .com projects. And ever since, I've basically been hooked. And now my passion for the last kind of 10 years has been very much payments, financial inclusion, how to create equitable access in financial systems. And somehow that led me to Bitcoin. And I've been hooked. I mean, I literally went down the rabbit hole in late 2010, early 11. I mean, very early. But I've been hooked ever since.
I mean, obviously, just a fascinating background. Tell us how you got red-pilled on crypto, on Bitcoin, and how you got into the space.
So I was part of the cypherpunk mailing lists back in the 90s, long hair, earring, all of it. And so I remember when DigiCash was around back in my Netscape days, it was very obvious that it was super interesting that you could have cryptographic-based money. But it was also very clear that this trust in DigiCash was never going to work. I mean, anybody who really understood what they were trying to do. And the holy grail was always to solve this double spend problem, meaning obviously how can two people have private keys to the same money and not have the money be spent twice? And we never thought that problem would be solved, at least most of us from an academic perspective. And so when the white paper proposed this idea to the double spend problem, my first reaction was I'm very skeptical that this is possible. And then when I really processed it, I said, okay, this guy or gal or guys, whatever, thinks that the only way to solve this problem is to use every single computer in the world. That doesn't really make a lot of sense. And so over time, I realized, well, their perspective is different. Their perspective is not to make an efficient payment system. Their perspective is to solve the double spend problem. And when you look at it from that perspective, I'm like, okay, this actually makes sense because it's basically a statistical solution to the problem, which basically in today's terms, we say, how do you basically more or less guarantee that you're not going to have a 51% attack on the network? Well, it's statistical. The more power you throw at it over time, the more secure the network becomes, et cetera, et cetera. And once it really sunk in that this could work, it just changed my life. But it took me a few months to really accept that this was as powerful as the author would have us believe.
Yeah, it took me a long time to get my head around Bitcoin in those very early days, 2010, 2011. I didn't quite understand it myself. By the way, I should say, I feel relieved that someone with a formal computer science background from Stanford, probably one of the top leading research institutions in the world in computer science, also had that same experience. It really is a big head shift, a big mental transition to make.
It is. And I hear people all the time like, oh, it's so great. We have these efficient, cheaper ways to do payments with crypto. And it's just not true, right? It's actually incredibly expensive to do this stuff with crypto. But that's not the problem it's trying to solve. The problem it's trying to solve is eliminating centralized trust. It turns out that eliminating centralized trust is incredibly expensive. And so, that's the price we're paying so far because we haven't found another way to solve it. My guess is there isn't. At least with modern, computing standards anyway.
So how did you first get into this space professionally? Obviously, you were saying at the beginning, you've done a lot of things working at Goldman, CIA, NASA. How did you make the transition into this space professionally?
Yeah, so I was doing a lot of work in the payment space, late 90s, early 2000s. For old flip phones, I was doing work in payments. And then when the smartphones came out, I was actually running a company that was trying to help documented immigrants be able to send money home easier using smartphones. We had set up a bunch of nonprofits in places like Haiti and Mexico to help people do that. And I was very frustrated as a result of all of the kind of barriers to entry from a regulatory perspective, just trying to move very small amounts of money around. And it becomes almost financially impossible to do that at any kind of scale beyond kind of the traditional Western Union model. And there's a reason why their fees are what they are when you dig in. because there's really no other way to create a sustainable business in that space up until I saw crypto, and that was what was so attractive to me when I realized that it could basically act as a kind of trustless system for moving money into places where the banks don't want to be, but the regulations are the same. I was like, whoa, this is really interesting. And that's what initially attracted me to Bitcoin and obviously now the broader cryptocurrency space.
So you guys spun up Abra over 5 years ago. What was the thesis? What were you passionate about doing then?
Yeah, so the original thesis was, could we build a new banking system starting with payments and then getting into other forms of or parts of the banking system? And it turns out we had the order backwards, right? It turns out that Bitcoin really was better suited as a store of wealth out of the gate. And it took me a while to catch up to that, partially because when I read the paper, it says peer-to-peer electronic money. And I focused on payments, which is what was interesting to me at the time. Ironically, I was kind of a closet economist, Austrian school follower and had read all the papers. I didn't correlate that to Bitcoin at the time because of my personal interest. And once I made the connection, I said, oh my God, how much Bitcoin have I given away? Everything kind of changed for me. And Abra, while we were initially very focused on using Bitcoin for payments, and this is pre-Lightning, of course, and mining fees were 10 cents. Once we made the transition to understanding how this was going to play out and the timing of how this was going to play out, we decided that it made more sense to enable investing in Bitcoin and crypto first, build wealth management tools for that, and then layer in things like payments and lending over time, which is what we've done now. And so we see ourselves as a full service crypto banking company, trading, investing for high yield, borrowing against cryptocurrencies, soon payments. But it's been a bit of a circuitous route to get there, just based upon, as you learn, you make a lot of mistakes in the early days of startups in terms of what's the first application? How do you get to market? Which part of your vision does the consumer want first? And it turns out that the part the consumer wanted first was this idea of holding a digital asset whose value should be, in theory, growing inversely proportional to how much money the government is printing. And so it turned out that was the right thesis for us to grow the business. And so it's been up and to the right ever since.
So tell us a little bit about where you are now. What are the products and services? Who are the clients?
Yeah, so the Abra, the best way to think of it is a crypto banking service. It's a very simple brokerage. You can swap between dollars and Bitcoin and 140 other cryptocurrencies, right? And so that was our kind of initial bread and butter. Then we have our high yield business called Abra Earn, which allows you to earn anywhere from 8 to 13% on dollars, on Bitcoin. You can earn yield on Ethereum and a few other cryptocurrencies, and that's been growing like crazy. And we have both a bank-based model for doing that. In the U.S., you would say you get a 1099, and then we have a fund-based model for doing that. We would say you can get a K1. And so we have family offices and trusts in addition to consumers. And so what I love about that is we have people saving in crypto in places like India, Bangladesh, Turkey, and then we have wealthy, family offices in the US doing the same thing. So that's the high yield part. And then we have Abra Borrow, which allows you to borrow dollars against your crypto holdings. So if you're long Bitcoin, and you want to borrow against some of those holdings because you want to use a down payment for a house and you don't want to sell, you don't want to reap those short-term capital gains, Abra Borrow is a perfect product. We'll actually do a 10% loan-to-value loan for 0% interest. I've never seen another product like it in the market. And effectively, we'll give you 10% of the value of your crypto holdings for free forever. You just roll it over, right? So, and then if you want to use less collateral, there will be interest rates, and we'll go up to like a 50% LTV on the retail side. And then we have an institutional lending book, which is a big part of the yield that we pay out in the Abra Earn product. And our lending book is over $1 billion today. So that business is growing fast, doing quite well. So all of this kind of starts to look and sound like a crypto bank, not necessarily a bank in the legal sense yet, although I think that's coming. And we have this kind of full service model for servicing everyone's kind of crypto needs.
So what's the legal structure that Abra exists under today?
Yeah, and this is going to change over time, but right now we operate under a bank trust model where we partner with in the US with a company called Prime Trust. And then we have similar partners outside the US. And so everybody who joins is effectively getting a bank trust account. They go through that KYC and then the customer identification CIP process. And once they're onboarded, effectively, we're managing custody through ourselves and our bank's partners in order to manage the brokerage and then manage the high yield and lending services. We have lending licenses in several U.S. states today. Some states don't require lending licenses for the business we're in. Some do. There's a few states where we have licenses pending in order to get up to 50 states. And our brokerage operates in 49 states today, minus New York, with this whole BitLicense thing. And hopefully someday that'll get worked out. But for now, we're in 49 states and we have customers in like 75 countries. So there's a pretty sophisticated regulatory framework here behind the scenes with a lot of law firms and in-house counsels and et cetera, et cetera.
Yeah, it really is a challenging patchwork from a regulatory perspective for anyone who wants to be a good actor in this space. It's really challenging to do this, sort of 50 state license.
Anybody who thinks that crypto is an unregulated kind of free-for-all doesn't understand anything about what's really going on. I mean, there are dozens upon dozens of regulators that oversee ABRA in some way. Right. It's whether sometimes like we've had BSA audits, which is the Bank Secrecy Act. And that's people don't even know like what's a BSA audit. Well, the IRS, nothing to do with taxes, comes in and audits your AML processes, your customer identification processes, et cetera, et cetera. And every bank, every money transmitter goes through that. Well, so do companies in the crypto space. So and that's just one small example of lots of things that are going on in parallel. So yes, it's definitely a very high bar to operate legally as a custodian in the crypto space.
One of the things I wanted to call back to, which you just mentioned, because it's a question we get so often here at Real Vision Crypto, is tell us about where the yield comes from. What are the activities that generate the yield that you're able to then pay out to your clients?
So think of the yield really as coming from three places. So if you deposit Bitcoin or dollars, which can get converted to stable coins or Ethereum, effectively you're getting yield as kind of a mix of three sources. Now, in the bank world, it's several sources, mostly lending, mortgages, business loans, commercial loans, car loans, et cetera, et cetera. The analogous kind of sources of yield in our world would be a combination of retail loans, which we just talked about, which is the ability to borrow against your crypto. Now, those are very low risk because the loan to value ratio is very low, meaning we're taking way more collateral, right, versus the risk of the price of crypto falling. Okay, so we've never had a loan basically default in retail because the loan to value ratios are just too low for that to happen. So that's one source. The second source is institutional loans, which are very similar to retail, except as opposed to doing it in our app where you just basically move your Bitcoin, we actually have to go through an onboarding process for each business counterparty, collect their business details, their balance sheet, use of funds. It's about a month process to onboard a new institutional counterparty. Our risk management processes are very rigid.
And this is because it's traditional. It's basically traditional underwriting, doing that analysis to understand the credit.
A little bit, but it's more like a prime broker in the sense that if there's still crypto collateral, right? But we have to understand more the use of funds. What's the existing leverage if it's a fund that's borrowing? So it looks a little bit more like collateralized lending in the prime broker world than traditional bank underwriting. Okay, so it's actually in some ways a little bit more complicated than bank underwriting because we have to dig in so much deeper into the use of funds and things that a bank doesn't really need to do for the most part, given the kind of verticals where they segment lending. The third area is DeFi. Now, this is the newest kind of component to the yield for us. Smallest piece, probably the most outsized amount of work to manage, but the returns have been excellent. Now, we've gone very slow with DeFi because it's very complex. It's 24/7. You've got to do things like smart contract code audits, manage exit fees. It's very complex. But like I said, the returns have been excellent, and we would like to do more. But we've been going slow just because it is so complex.
But walk us through that model, what it looks like, how you do it, and how it generates yield.
Well, DeFi is basically, there's a few ways, but the most common way is basically a smart contract that acts like a lending pool. either for a liquidity pool or for some other reason. Effectively, you put USDC into a contract, and if you put X in, you get X plus Y out. It's that simple. Now, usually what's happening is that you're being paid not only back in kind, meaning you're not just getting USDC back, you're getting another token back at the same time that represents the token used by that protocol, right? So, you've heard of Maker and Compound and Aave and some of these other pools, and they'll pay back in their token. So managing liquidity and payouts is actually very complex because we don't want to be taking risk in those alternative tokens at the same time on behalf of our depositors or our bank's depositors. So we have to actually manage the conversion of those tokens back to dollars as well in order to have minimal to no impact on the yields, okay? Because we're not really trying to take speculative risk to generate yield here, right? One way to do it would be just invest in Aave and that's your return. Well, that's not really a high yield fund, right? That's just taking speculative risk on crypto. So you're not only getting your principal back in kind, in this case, let's say USDC, you're also getting paid back in a component of these alternative tokens, which then has to be managed. And if the price of those tokens is moving abnormally, it can actually affect the exit cost for getting out of a contract, which can affect the yield. So when people get into DeFi, a lot of people look at the contract is paying 28% on USDC. This is incredible. I should just put all my USDC in this contract. But what they don't understand is the nuances of how it pays out, what it costs to exit the contract, what it costs to move something around on the Ethereum network. All of these things factor into the net yield, and we have to manage them proactively on behalf of all of these depositors using our own risk management processes.
So let's talk a little bit, now that we have a sense of what the operating lines are, let's talk a little bit about what your vision for the future is. I should point out you guys have just finished raising, I think, a Series C round in September of 2021, bringing the total raise in those rounds up to over $100 million. You've got some very well-known investors in there on the VC side, including Amex Ventures. Tell us a little bit about what the vision is for the future.
Yeah, I mean, it's very, very salient that you mentioned American Express. I think that as one of the largest shareholders in the company, as I said, I think this moves in the direction of being kind of the future of banking. I think that the banks, not necessarily because they're dumb, just because of the hand that we've all been dealt, are kind of asleep at the wheel in terms of where all this is going. And so that's our opportunity, right? And so I think that you're going to basically see a whole bunch of countries, first of all, leapfrog us in terms of how they do banking to be crypto first, right? So if you're in emerging markets and you have the opportunity to store dollars, and I'll put it this way, maybe a dollar is less of a shitcoin than the shitcoin being printed by my government in one of those countries, and I have the chance to hold dollars, earn yield on those dollars, but move my generational wealth, whatever amount it is, whether it's hundreds of dollars or millions of dollars, it means the same thing to everyone. I can move part of that generational wealth into Bitcoin legally, right? People in India use gold jewelry as a means of storing generational wealth, and they hand it down from generation to generation. But they don't borrow against it. They don't buy houses against it. They don't make payments against it. They can do that with Bitcoin. Most countries don't have the credit system we have in the US. So think about this now. Abra is going to have, certainly within 24 months of where we are right now, we have customers in 100 countries. But the next phase for us is everyone is going to have access to instant on credit based upon the amount of crypto you're holding to do whatever you want with. Access via Apple or Google Pay, use for a down payment on a house, send your kids to school, whatever. Okay, so you basically end up with this full service banking model that bypasses this US convoluted credit scoring system and takes that Indian gold jewelry, converts it to Bitcoin, and now gives you instant credit against it. And that will work in, think about it, India, Bangladesh, Indonesia, Philippines, Turkey, places that in the aggregate are a couple of billion people that have a lot of GDP in the aggregate, but effectively zero retail credit. Everything's debit based. This changes all of that and turns Bitcoin and Ethereum, in my opinion, into the basis of the future of banking. Bitcoin as probably the store of value, and Ethereum as the rails for payments and banking systems. And you're going to see Abra develop a series of services that are global, right? We don't really see a huge difference from country to country in terms of what people want. It's just local regulation and existing payment systems that are different. And we see this as kind of a global framework for developing a truly global banking system based upon crypto.
Yeah, there's so much there to unpack. Talking about the U.S., this notion of being leapfrogged by places in emerging markets that don't have the regulatory hurdles that we do, and that also are perhaps lacking some of the basic infrastructure that we take for granted. It's probably important to point out that we have a lot of people here in the United States who are currently unbanked. Talk a little bit about the potential for digital assets to help to ameliorate some of those challenges that those folks have.
So there's a few things, right? So the first of all, the cost of servicing a customer in the banking system is not zero, right? And so if you have $25 in a bank account and you're not basically generating debit card fees or overdraft fees, the bank is either losing money on you or at best breaking even. Now, try calling customer service once, the bank has now lost money on you that month, okay? Because it probably cost $15 to process that call. And so, there's a threshold where the banks basically don't want you as a customer, or are motivated to make sure that you're paying ridiculous overdraft and other fees for little tiny mistakes that you might make in order to make you a profitable customer. And there's a reason, as I said earlier, why Western Union fees are what they are, right? It's yes, they can get away with it, but two, if those fees, if there wasn't that floor in remittance fees, they wouldn't make money. It wouldn't be a sustainable business. Now, the floor is probably like 6 or 7% for most countries, but that's a lot of money at scale, right? It's tens of billions of dollars. So I think that the cost of being a cash consumer remains incredibly high globally, even in the US. I mean, I think my guess would be that if you're a truly cash consumer, there's an incremental cost of anywhere from 8 to 15% of your income that's just gone off the top. Now think about that for a second. That's thousands of dollars a year that you and I don't pay in fees. It's the opposite. We do get, it's 0.1% or something like that if we leave money in a checking or savings account as opposed to Abra. But still, it's the opposite, right? So the opportunity is to put those people into new world accounts like the Abra model that can start to give them generational wealth, address the fact that over time, this is going to become a better store of value. You can borrow against it. You don't have to worry about traditional credit scoring. For us, the people who are in that unbanked segment are very similar to the people outside the US who have no access to credit anyway, because there's no credit scoring system. So, we really see this as the great democratizer and the great leveler in terms of access.
So in terms of the U.S., what's the current state of play with regulation and where are we headed?
Wow, how much time do we have? So that there's so many angles and perspectives to answer that question correctly. Yeah. So you have state money transmission, you have also state banking regulations, because you have places like Wyoming now and Nevada and other states that are trying to develop trust or bank models that treat crypto under a bank regime differently than FDIC insured funds, which I think is extremely compelling. And then, of course, places like Florida that are trying to be a haven for this. And then outside the US, there's governments like Singapore and Bermuda and others that are doing right. But just in the US, I think that the things that matter the most are custody, derivatives, and securities. So let's break the three down. So on the custody side, it's generally been the states that regulate that. I think Anchorage might be the only company in the US that custodies crypto via an OCC charter of some kind. I may have that wrong, but I believe that's true.
I think there are two now, but this is the idea here is that these are federal charters by OCC,
right.
Rather than
maybe
state regulation.
But I think Anchorage was the first, right? And then Gemini, I think, operates under New York Trust, and maybe BitGo had another trust, maybe from Washington. And most states like Abra operate today under a combination of money transmitter and trust licensing, but again, all at the state level. At the derivative level, it's basically the CFTC for Bitcoin and for commodities. And there's only a couple of licenses that exist for effectively what amounts to leveraged positions versus commodity spot positions. And that whether it's a swap execution facility or something like that. And now FTX buying out LedgerX is probably the biggest example of that. But the CFTC is woefully understaffed and does not have adequate any resources of any kind to basically scale that to multiple regimes, which is why you don't see a lot of leverage in the U.S. market versus other countries, at least for people who are using the systems correctly. And then there's on the security side, you have both, tokenized securities and then leverage or derivatives. And the SEC has basically completely punted on anything related to securities-based derivatives. They did not implement the swap execution facility provisions of Dodd-Frank, which I believe should be illegal, but they didn't. They chose not to do it.
Why don't you explain that for people who may not be following this story that closely?
Yeah, it's complicated, but basically anything related to a security swap in this country requires basically an exchange to facilitate that transaction. And I'm not using legal terms here, so I'm just giving you kind of a layman's explanation. And that would basically fall under what you would call a swap execution facility, swap basically being a generic term in this case for some type of derivative. And to my understanding, there's no legal way at all to do that in the United States today. I'm not even talking about crypto. I'm just saying in general, right? So you don't really see any type of outside of puts and calls on stocks, which is a separate regulatory framework. You don't really see any type of swap facilities running in the United States legally today. To my knowledge, it's not even possible. And so Congress is continually questioning the SEC as to why they haven't implemented this. And the answer is usually we'll get around to it. But Dodd-Frank is going on, 10 years plus now. So anyway, so I think the bigger question as it relates to crypto is what's a security, what's not a security? When are we going to have a framework for tokenized securities so that basically these can trade, more efficiently and have real-time settlement and things that actually make more sense? And my working assumption here is that it's not going to happen first in the U.S. and you're going to see robust tokenized securities models happening in places like Singapore and other kind of aggressive markets that get it, or at least are in a position to implement it faster. And then that will show the U.S. that there is a framework for doing this over time. And then maybe by default, we'll have a clear understanding of what's a security and what's not a security. And it won't just be everything's a security and please come in and talk to us, which is, kind of been this blanket statement from the SEC right now, which hasn't really helped anyone. Anyway, long-winded way of saying that it's a mess and we need a lot more clarity. And ideally, we need fewer agencies, but we're moving in the direction of having more agencies. And I don't know how we get out of that.
Yeah, there's so many important points there. And some of the challenge is just the idea of retrofitting cryptocurrency and existing regulations and existing regulatory frameworks, something that we've been seeing a lot come up. Obviously, this week we're recording here on February 9. We've just seen a great deal of talk about taxation for staking and also a bill that's currently being introduced in Congress to exempt digital asset cryptocurrency transactions below a $200 threshold for precisely this idea that they're just, basically being retrofitted in to existing regulation. There's just a lot of stuff in the crypto space that doesn't make sense to bring in to a sort of legacy financial framework.
Yeah, absolutely. And look, this idea that, converting small amounts of crypto to make payments should be a taxable event is just, it's untenable. The average consumer is never going to be in a position to keep track of small conversions via some crypto debit card where the payments were automatically made by converting Bitcoin to a stablecoin. It's just never going to happen. And so it makes more sense for the government to step in and say, okay, intent matters. And if your intent is basically to manage a store of value for investment purposes, you have capital gains. And if it's above a certain threshold, yeah, okay. I don't agree with necessarily capital gains on crypto, but if you're going to do it, there's some threshold where it makes sense. And if you're going to use it for payments in small amounts, then these aren't taxable events. And so, that makes way more sense to me. Just like, if you're holding 50 euros in your pocket and you go to, Travelex at the airport, no one is reporting those as Forex transactions on their income. Now, I don't even know if you're supposed to, honestly, but I'm pretty sure no one is. And so I think we need to think about crypto in similar terms.
Yeah, and there's probably some reporting threshold. If it's 50 euro, it's obviously a very different scenario than if it's 50,000 euro. And some of these, just getting our heads around this. Let me ask this: as we have these conversations, it's so clear, I think, to people who are watching this space just how early it is to try and make these decisions, to make these determinations. What sort of time horizon do you think we're going to be working on to hammer out some of these issues? In other words, when might we get to a place where we start to feel like we have at least the foundation of a regulatory framework that begins to look like something that's makes sense?
Well, the challenge there is a couple of things. One, some governments are actually going to decide that Bitcoin is viable legal tender. And once you do that, it's not treated like a commodity anymore. And a lot of the tax implications either go away or are very different, right? Now, the US is probably not going to, at least at the federal level, make that distinction anytime soon, meaning Bitcoin and Ethereum and most of these other kind of things that are labeled as commodities will probably stay commodities for quite a while. And I think that part of the problem is that there's a lot of politics overlaid on this. And so you get different kind of regimes in control, and, you know, their perspective changes depending on which way the wind is blowing during that year versus the next year. And so that may actually be our saving grace, because if the perspective keeps changing like a sine wave and nothing gets done, maybe that's the best way we can keep innovating while they basically maintain the sine wave and make no progress on. And I'm using progress in air quotes, because to me, doing nothing and doing no harm is should probably be their first perspective. You know, we have that oath as in the medical industry, but we don't have that oath in Congress, where their goal should be to do no harm. If that was the case, we wouldn't be printing money the way we do. But you know, I don't really have much hope that anything useful is going to happen. A central bank digital currency doesn't really help much, because it's the same nonsensical monetary policy, just in, you know, purely digital form. You can keep printing them, right? It's just that they're ones and zeros now instead of pieces of paper with serial numbers on them. So I think that the private industry, whether it's, you know, private stable coins, digital banks, crypto banks like what Abra's doing, exchanges, they're our best hope, in my opinion, to basically take us to the promised land of a better monetary system, a better banking network, more and fair and inclusive access. And I'm not looking for governments to solve those problems. My best hope is least amount of intrusion and mostly staying out of the way.
What role do you think Bitcoin specifically is going to play in this digital ecosystem?
Well, for sure, it is the best potential store of value we've ever had in terms of being the hardest money. I think we're in this kind of, and Raul talks about this a lot, we're in this kind of network effect driven phase of accumulation. Now, this isn't a new idea, right? I mean, this is something that Hayek wrote about in the 70s in terms of what would happen if we had a truly private money where there was a guaranteed monetary policy that couldn't be changed. Right, he predicted exactly what's happening now, which is that wealth would be accumulated, or that money would be accumulated because it would be so valuable, which is exactly what's happening now. And you basically get exponential network effects, which is why if you look at the Bitcoin price in a log chart, it looks like a straight line up and to the right over the last 10 years. But you get interruptions in those network effects, like China banning and other things that have happened. But like I said, in a 10-year log chart, it looks like noise. So I think that we're on the path to Bitcoin becoming the best monetary physical asset, digital asset, that we've ever had. It's not there yet, but the meteoric price rise is being driven by the network effects, which are being driven by that promise, meaning that it will get there. And I believe that it will get there, whether it's at a price of 10 trillion or whatever, I don't know, but that's where it's headed. Okay. And so at that point, you won't see a price rise versus dollars, and the price versus dollar probably won't even matter that much. So that's part one. It is on a path to becoming, that global store of value. Then part two is an open question to me. Can we scale a payment network based on Bitcoin itself that is accessible to 8 billion people, or however many people we have by the time we get there? We don't know. Right. I believe Lightning can work in small amounts at large scale, technically. It's less issues around incentives, meaning what is my financial incentive to run a Lightning network?
Bill, for people who aren't following the Bitcoin space as closely as you are, give us the 50,000-foot overview on the Lightning Network and your analysis of it.
Lightning basically acts as a second layer on top of Bitcoin that takes transactions off chain and effectively creates little tiny channels that you can route between to do effectively micro transactions at either for free or incredibly low cost that can eventually settle back onto the Bitcoin network, but maintain kind of the pseudo anonymity and all of the best aspects of Bitcoin, minus the ability to actually process real time onto the chain itself, or every 10 minutes onto the chain itself. And so the theory is that this should scale infinitely better than trying to just increase the block size continually as usage grows, which is how you would normally scale a blockchain. As I said, there's been a huge number of technical challenges in getting this to work, which is why it's been over 5 years since the idea was first proposed of these kind of payment channels as a solution. The biggest challenge, which really isn't, well, it may be technical, we're not sure yet, like I said, is what is the financial incentive for running these channels? And we just don't know, right? There's lots of theories, and people are doing it because it's cool, and they think it's great for Bitcoin, which is why Square is doing it, and Jack Mallers' company, et cetera, et cetera. But they don't really tell you if there's a business model behind it yet. And there may be that the business model is doing other things like credit, but that doesn't actually address how to get Bitcoin itself to scale as a payment network. So as I said, the technology seems to work, which is great. That's kind of the first step. But then we need a business model for it to scale as well. And then the third aspect of this is credit, right? So given that you basically have over time a deflationary asset, how do you build credit systems here? And I think, this is the point where, certain folks like Michael Saylor say, well, the dollar needs to coexist with Bitcoin because one, we have an easy way to do ephemeral transactions, and we have an easy way to basically, use an inflationary asset to generate credit effectively against a deflationary asset. And we'll see over time what that interplay is between digital property and traditional fiat, especially assuming fiat stays off of any kind of hard asset standard. But that's probably the evolution of Bitcoin for the next 15 years, meaning the two will interoperate with dollar-based credit off of Bitcoin as the hard asset. And we'll see then in parallel how the banking system evolves, probably based more on stuff like Ethereum, other layer one protocols like Solana. Now, there's companies that actually want Bitcoin to be the kind of transactional system layer for banking as well. Little skeptical that it can play that role because it's not really Turing complete on the technology side, meaning the smart contracts can't do much for Bitcoin. And so Ethereum seems to be better suited for things like DeFi and NFTs and all the other things that smart contracts are doing today. So anyway, so it's going to be super fun to see how this all plays out over the next few years.
So speaking of layer ones, what do you think when you look across the ecosystem at the evolution of layer ones in the smart contract space? I'm talking here about Solana, Cardano, and others as competitors to Ethereum. And for folks who may not know, obviously one of the challenges here is the transaction pricing right now, incredibly expensive to do transactions on Ethereum. Tell us a little bit about what you think about that space.
So let's break it down in terms of why these things exist in the first place, right? So Bitcoin was created to solve the double spend problem associated with the idea of a digital currency. Meaning if two people have an exact copy of a private key, what's to prevent both of us from spending the money at the same time? The idea of Bitcoin blockchain and proof of work solves that double spend problem. It actually has a scripting or programming language built into it. It's very rudimentary. It really only enables signing of transactions. I'm simplifying here, but effectively only enables signing of transactions to move Bitcoin around or create these unspent outputs and then new transactions with more of these unspent outputs. It's like the change maker that a taxi driver would have. When he makes change, think of Bitcoin transactions as kind of functioning like that. So Ethereum, the idea is that we could expand this idea of just very simple transactions with the smart contracts that could effectively do anything, like a programming language, Java or C, but integrated with this idea of a cryptocurrency, in this case, Ethereum. Or ETH, right? And so the challenge with that is that it doesn't really scale very well, meaning you can't do lots of transactions at the same time like you can with Visa or any other centralized database where you can just throw more CPU, at the problem, or replication servers, or whatever you want to call them, and scale these transactions. And so then you have issues around security. And so what's happened is the original Ethereum model has been expanded to look at different perspectives on how to make it more scalable, which is what technologies like Solana are trying to do, or how to make the contracts more auditable and secure, which is what Cardano is trying to do. It's a very academic perspective from my point of view on how to build smart contracts, which for many projects, maybe governments and money, could be very interesting. And so they're all trying to solve different aspects of this, but everything's a trade-off. Decentralization, which is ultimately what cryptocurrencies represent, is incredibly hard. It's really expensive, meaning it's expensive in terms of energy if you're doing proof of work. It's expensive in terms of throughput if you're trying to build banking and stablecoin systems. It can be expensive to do your on-chain transactions. If you've ever tried to move Tether or USDC around, you know what I'm talking about. And so fixing all of that is all trade-offs. And so each of these systems is looking at the trade-offs from a different perspective to solve different problems, right? Solana is optimized for gaming right now because it's such high performance and high throughput that it doesn't worry about the security of money movement the way Bitcoin does, or the complexity of smart contracts the way Cardano's new Plutus system does, et cetera, et cetera. So it's all trade-offs.
Yeah, and this is right to the core idea of the so-called trilemma in blockchain, where basically everything represents a trade-off between decentralization, scalability, and security, and that these different systems are solving and managing and optimizing that trilemma in different ways, and therefore having different outcomes. It sort of suggests that there is the potential for the coexistence of multiple L1 smart contract chains.
Oh, for sure. Yeah, that's going to happen. I mean, there's no way that Bitcoin can be everything to anyone, and it shouldn't be. Bitcoin should be the best digital property we've ever had. I think Ethereum has the chance to be the world's computer for applications that are optimized for its network. I could see Solana basically becoming the world's gaming and entertainment platform. It's so early. I mean, and then you're going to see a lot of networks optimized for moving across these chains. Right. You saw the funding announcement for Layer Zero. I got some friends working on Thorchain, which I think is really interesting.
Let's unpack that, because I know a lot of people get very confused when they hear Layer Zero, this idea of these secure cross-chain platforms.
So it's in very simple terms. How do you basically move between Ethereum and, let's say, Bitcoin, right? In very, very rough, simple terms. Think of those as being parallel universes that have nothing to do with each other, right? It would be like I have a matrix over here and I have a matrix over here, and there's no hard line between the two. And so right now it turns out that some of these universes that are parallel do actually use compatible private key based models for storing digital assets, or basically storing your access to that parallel universe in the form of a private key. And that kind of enables it's complex, and there's different models for doing it. Like Thor works very different from Layer Zero, but there's now these models for basically being able to securely and quickly move the assets between those parallel universes. Think of it as almost like an atomic swap, but actually in some ways is either more efficient or yeah, there's some really interesting white papers out there on how these things work, but they're not for the faint of heart, to be honest. But it is, I think, going to be a very big theme over the next couple of years, is how to deal with the multi-chain world.
And this is extraordinarily difficult from a computer science perspective. We should point out, we're filming here on February 9th. I think I said February 8th a little bit earlier, but on February 9th, obviously, in the last few days, we just got this report of the wormhole attack with the bridge between Solana and Ethereum. I think a $320 million loss because of a flaw in those smart contracts. This is incredibly complicated stuff to do.
Yeah, it is. And so that's true. And anybody who's implementing this who looks at the hack and what's happened will say, oh yeah, that was really hard to we wouldn't have thought of that, right? Well, I take a little bit of exception to that. I think we're moving so fast in this smart contract world, and everybody's afraid of vis-a-vis the project they're working on of being late to market, that a lot of the basics aren't happening correctly. Number one, we're supposed to be auditing smart contract code. This is representing digital assets that have huge value. We're talking about hundreds of billions of dollars of total value locked in DeFi. We're talking about tens of billions of dollars moving around in NFT sales every month. And there's very little difference, by the way, in how value moves around in DeFi and in NFTs. It's just smart contracts. And so when this code is not tested for weeks and months at a time and doesn't go through extreme audits, you end up with this scenario where you have, money lost. And it sounds like, it was some difficult to find flaw. Well, then I always go back and ask myself, what were they doing? How many weeks did they spend in a test net? Did you actually run in a test net? Right? And I'm shocked at the fact that this keeps happening again and again and again. This is why Abra is going so slow with DeFi, right? It's we don't know who to trust. And so we don't trust anyone. And as a result, we basically do the work ourselves of digging in and paying other people to help us dig in to the source code on these contracts.
Yeah, in some ways, this reminds me, and I know that you were absolutely at the epicenter of this in the 1990s. It reminds me of the sort of the progress that we made for Web 1.0, Web 2.0. It was not just a straight path ever upward to nirvana. There were a lot of challenges along the way. There were these systems, abstraction layers stacked on top of abstraction layers, services that had to be built. It took an extraordinary amount of time. You were involved, you mentioned earlier, in some of the foundational work of SSL, Secure Socket Layer, later TLS. This idea that there are effectively different layers, services in the internet that permit secure transactions to take place. What are some of your takeaways, and how can that be sort of applicable in the way that we think about what's happening now in layman's terms?
This is a tough one because think about it, right? TCP/IP, which is the protocol for the internet itself, developed over decades in the lab, right? And so now these protocols develop over weeks and they're released to the public. Now, why is this happening? The biggest reason why this is happening is that we're putting monetary value on these protocols in real time. Okay. If TCP/IP packets cost money, I suspect the internet would have evolved very, very differently. And TCP/IP packets do cost money in the sense of you have to pay for access to bandwidth. But if the packets themselves, were tradable, which the idea doesn't really make sense. But just humor me. If they did have monetary value and were tradable, the internet would have evolved very differently than it did. And so now what's happening is because there's so much money involved in these protocols, and they are solving, in some cases, real problems very quickly, that there's a mad rush to get things used and commercial and functioning. And we don't, and whereas before it was very academics driven in terms of, what is TCP/IP, what's SSL, what's LDAP, what's X509, which is the certificate standard. And so those things, yes, they were commercialized. There were companies involved in creating them, but there were all these standards bodies and things went a little slower because we knew it was foundational. That's not anybody's perspective today. And I'm not saying that's a bad thing. It just is, right? Everybody's perspective today is this stuff's worth a lot of money. It's changing everything. We got to get it out there and we want people using it. And fine, I accept that. But then we need a certain amount of caveat emptor. What I don't want is the government coming in and saying, okay, you all can't figure it out for yourselves, so we're going to figure it out for you. That's a disaster, right? So we need a certain amount of caveat emptor here, which means buyer beware, to say, okay, you're basically on the front lines of using DeFi if you're using DeFi today. You're on the front lines of adopting the NFT concept, whatever it means, whether it's collectibles or house keys or anything else in the future. And you should accept that being on the front lines of that carries a certain amount of risk.
It's fascinating when I think about this space, and you mentioned the foundational roots of the internet. I mean, dating back to the late '60s with ARPANET and this sort of very slow, inevitable, inexorable march toward greater connectivity, and now we find ourselves in this period where we have the capacity to decentralize the transfer of value, identity, and trust, to build that into the network itself. And again, it seems to me like it's the same thing, this just slow, inexorable march ever forward. And yet at the same time, as you say, because of the monetization of these digital assets, you have this massive sort of acceleration. There's this incredible amount of experimentation in this space. It's like Schumpeterian creative destruction on amphetamines just happening, and people lose money. There are hacks. There are fundamental flaws in these systems because they're being rolled out so quickly. And so you have this weird kind of crashing dissonance between short-term risk and ultimately this long-term accretion of value.
Yeah, I'll give you my deep thought of the day, right? So the way I look at this is, at least at the highest level, I think we reached kind of peak technology centralization with the moon landing, the first moon landing, right? It was basically the biggest effort since the building of the pyramids to get a whole group of people to accomplish one insane goal, which is to take a tin can and put it on another planet. Which, when you think about it, it's just pure insanity that we could do that in the 1960s. Okay. Now, since then, from a technology perspective, by and large, we've been on a methodical march towards decentralization, particularly in the digital terms, right? So we had big monolithic computers. We went to PCs. We got the internet. First, we got basically dial-up, networks. Then we got a global internet. Then we got smartphones. Now we have blockchain. I think AI is going to proliferate into homes and basically make things even more decentralized. And we don't know how that's going to play out, but that's all a movement towards decentralization. At the same time, we're just now reaching peak government centralization. All right, and you see what's happening with Occupy Wall Street and how that evolved now with post-COVID. I think the pendulum, and Balaji's talked about this, the pendulum is going to swing the other way towards anarchy, in my opinion. But it's not happening at exactly the same time or exactly the same way that the decentralized movement on technology is happening, right? And so, and then the third kind of thing that is converging with the other two is the debt cycle, right? And bond markets historically drive everything, especially global wars. And I totally agree with Ray Dalio on this, that the idea that traditionally debt cycles don't end well, but we have a couple of new things happening this time that are maybe offsetting this human frailty. Number one, Bitcoin and this movement of decentralization, and two, this idea that we've reached peak centralization from a government perspective. All of these things are going to start converging over the next 10 years, and nobody knows how this is going to play out. But it's going to play out, I think, differently than most of the other debt cycles we've had before. And I just don't know how. Well, I hope it does, because I don't want war. But in any case, I do think it's going to end differently. And I think Bitcoin is going to be a huge driver of that. And it's being very much underestimated now in terms of its global influence over the next 10 years.
Well, an amazing conversation, wide-ranging about finance, economics, technology. As we come to the conclusion of this conversation, final thoughts, key takeaways that you'd like to leave our audience with?
Yeah, look, I think we're in a huge transition towards a digital financial economy. The 90s, 2000s with Web 2.0 represented the transition towards an internet and a smartphone economy. Now we're seeing that finally play out with money and banking. First with Bitcoin, and that's still happening. And now that's being overlaid with things like Ethereum and other kind of protocols. And so there's a huge financial opportunity for people who can kind of dig in, educate themselves, get a little bit of conviction for that. And then I think there's a macroeconomic perspective on how all of this is going to influence how the world evolves, given where we are right now. So there's kind of the, how do I invest in this new economy that's happening? And then where's it all going? And should I be scared about that, independent of whether I make money? And I'm hopeful. But in the meantime, we've got services like Abra there to at least help you kind of bridge your way into the new economy at the same time.
Bill, thanks for joining us.
My pleasure. Great to be here.
Thanks for watching, everyone.
Hey there, visionaries. Your free membership to Real Vision Crypto, the world's premier source for cryptocurrency and digital asset analysis, is available right now at realvision.com/crypto.